Lesson 7, Price Swings and Fibonacci Numbers. Before we get started, I'd like to point out a couple things. Through this lesson, you'll see this important notice sign up in the top left-hand corner. That is a trader's tip, or on that page when this sign appears, there will be some important information that I think you need to know and perhaps even memorize. That information on that page can participate greatly at either A, helping you make money, or B, learning how to save money. The next thing I'd like to point out is in the bottom center of each one of these slides there is a number. There's a number on your computer here and a number on your workbook. If by chance you lose yourself in the workbook during this lesson, just find the number that is playing on your computer or on the screen and match it up with the number in your workbook. There are 16 lessons on trading the Forex that can participate in helping you learn to trade. These lessons are focus in on technical analysis. They are also very applicable to all other markets. Remember that the art and the education of learning technical analysis places you in a position to read charts from whatever financial product they come from. Successful traders will do what unsuccessful traders can't and won't do. This is perhaps one of the most profound statements I have heard when it comes to successful people. Change the word traders to people, and what you have is successful people will do what unsuccessful people can't and won't do. Successful people are successful for a clear reason. Successful traders are successful for a clear reason. They are successful because they have properly educated themselves about the niche that they are working in, and they have acquired a set of disciplines, and those disciplines have become a habit. Success is a habit, just like failure can become a habit. So as you listen to this lesson, I would have to say this lesson is probably one of the most important lessons when it comes to trading, because it teaches you about the price swing and the natural movement of the market. There is a 21-day 3% rule that I believe in. The human mind forgets 80% of the knowledge it acquires within 3 days. Over the next 18 days, it continues the loss of information until it settles at retaining only 3% of the original acquired information. You need to play and understand this lesson. It will participate greatly in helping you become successful. If you don't continually play this lesson over and over again until you completely understand it, if you don't use it, you'll lose it. Look at how within 3 days you will have lost 80% of the information that will exist on this lesson. By the end of this lesson, you will understand that the markets can only move up, down, or sideways. You'll learn how to read a trading chart and be introduced to the technical side of Fibonacci trading. You will learn that there are natural laws and a numerical sequence that governs our universe as well as the market. You will learn that these laws apply to the world financial markets and can be figured out for profit. You will learn to create a trading plan based on these laws and how to financially protect yourself at support or resistance on every trade. To help you understand the trading the Fibonacci's, I'd like to go over and review reading a trading chart and placing your orders just briefly. Remember, we are using Japanese candlesticks that monitor the open, the high, the low, and the close of any time period. They're bullish candles and bearish candles. If you'll look at this chart, the bearish candles are black, the bullish candles are white. These candlesticks can be any time period. They can be an hour, 2 hours, 5 hours, 10 hours, a day, a month, a year. The charts that we look at are bid charts. They monitor the bid price. This is very important information. There is a bid price and an ask price. The ask price is approximately 3 to 10 pips higher when it comes to trading currencies. If you're trading other products, the difference between the bid and the ask is called a spread. Bid prices, if I had an ask chart up here, would look identical to the bid prices. So in currencies, depending on which currency you're trading, there is a 3 to 10 pip spread between the bid and the ask. As we buy on the ask and we sell on the bid. This is important information, extremely important information. If you are a bull and you enter at the market, you will buy on the ask. This price that's being monitored is the bid price, which means if you were to buy at the market right now, the bid is 107.30, the ask would be 5 pips higher approximately to 107.35. Your stop order, with every buy you need 2 sells, your stop order would be on the bid, which means all the candle has to do is come down and hit that price, and you'll more than likely be stopped out. Your limit order is a sell limit. Every buy has 2 sells. It will also be on the bid. All the candle has to do is come up and somewhat hit it, and you will more than likely be filled. Conversely, we sell on the bid. If you entered the market right now and the current price on the bid was 107.30, you would enter at 107.35 approximately. That would be your fill. Your stop order would be a buy stop and would be on the ask. That means as the market rallies, the ask price would hit your order before the bid price would, which means if the candle rallied and did not hit your stop order and fell, you still might be stopped out because the ask hit that price. A lot of traders get confused over that, and they think they're still in a trade, and all the time they've been stopped out. Conversely, as the market falls, the bid price will have to go through your ask price in order for your ask to be filled. Many times the candle falls and it hits your price here for profit, and you're not filled because you buy on the ask. So please pay attention to that. It's very important information. Types of orders, we deal with a market order. A market order is an order placed at the market. If you're buying on the ask. If you're selling on the bid. A limit order is an order placed to enter or exit the market at an exact price, and you are filled at that price or better. A stop order is an order placed to enter or exit the market at the exact price and turns into a market order when touched. Those are the rules. Let's just look at this chart again. If that is where the market is, any order placed above or below the market would then become a working or open order. Those would be orders that are not filled. They are sitting out there. If you entered the market right now and placed an order to sell above the market, that would be a limit order. If you were to buy above the market, that's called a stop order. If you placed an order anywhere down here and you wanted to buy below the market, that's called a limit order. If you want to sell below the market, that's called a stop order. Please understand this, memorize it. The reason I want you to memorize it and understand it is because stop orders are subject to slippage. They turn into market orders when touched, and you can be slipped and receive a different fill than what you had anticipated. Ordering rules: for every buy there needs to be 2 sells, 1 for profit and 1 for loss. Let's look at this. Market breaks a trend line. You enter the market on a buy. Your stop order goes at the last low. Every buy has 2 sells, a sell stop order and a sell for profit. So every sell will have 2 buys, 1 for profit and 1 for loss. When you sell, you're shorting the market. You want the market to go down. You will sell first and buy second. Let's look at this. Market breaks the trend line. You enter the market selling. You sell on the bid. Your stop order will be a buy stop, and your limit order will be a buy limit order. Each sell has 2 buys. OCO means whichever order the market hits first, it will cancel the other. If you want to buy and place a stop order and a limit order, set it and forget it. You don't have to sit at your computer and watch the market move. You can literally set your limit order, set your stop order, and walk away. One of three things will happen when you come back. One, you'll still be in the market. Two, the market will have hit your limit order for profit. If it does that, it will cancel your stop order. You will not have an open working order out there if it fills this one. If you come back and it hits your stop order, you will take a loss, and the market will automatically cancel your limit order. One cancels the other, which means you will not have a working order left over after one is filled. Cancel, replace. You'll learn a lot about all these orders in lesson 1 and in lesson 3 on equity management, as well as lesson 16 on trading strategies. But remember, as you chase the market and cancel and replace, only cancel and replace to the new last low in an uptrend after the market makes a new high. If you've moved your stop from here to this low, wait till it makes a new high, retraces back, bounces, U-turns, and then makes this new high before you change your order from this low to this low. As it's making a new high, it will stop. You can learn a lot about that in this lesson. You'll understand the whys. It stopped there, and the whys that stopped here. That's what this lesson teaches. But wait till it retraces back, bounces, and now achieves a new high before you move your stop order from here to here. Chasing the market via canceling and replacing is not a greedy way to make money. It is an educated way to make money. The same will apply, but in the opposite direction. Only cancel and replace to the new last high after the market has made a new low. If this is where your order is, then wait till the market has made a new low, come retrace a little bit, U-turn, and see now that it's making a new low, taking out the old low. When it makes a new low, you now can cancel and replace to the last high. That would be the last high. You can keep canceling and replacing until you are stopped out. Bulls, buy low and sell high. For whatever reason, here's an indicator. Market Traders has some great indicators you can use that can participate in helping you find comfort in the number that you choose. Bulls want to buy low and sell high, buy low and sell high, buy low and sell high. These three moves based on an indicator produce 290 pips. At $10 a pips, that's 2,900. 10 lots would be 29,000 over a 2-day period of time. Bears. If you want to become a bear, you'll be shorting the market. The broker will give you the right to short the market. Margin requirements are approximately $1,000 per lot as you trade, but bears are also buying low and selling high. They are just doing it opposite. You will sell first and buy second, but look at how you sell high and buy low. If you sell high and buy low, did you not buy low and sell high? If you bought something for $104 and sold it for $107, did you make a profit? Yes, you did. These two moves based on an indicator produced 350 pips or 3,500 for one lot. 10 lots would be 35,000. If you do not know how to short the market, feel free to call our company. We will explain it to you in detail, or read the back of your manual. It explains there on how to short the market. The next thing is technical traders learn to read charts. That's what this lesson is all about. Technical traders read charts like doctors read x-rays. To a trained eye, the chart is telling a story. It is telling the trader where the market should be going. Technical analysis gives traders a high probability of knowing where it's going. The reason why is because we are creatures of habit. Human beings have a tendency to repeat their actions. And as we repeat our actions, charts are doing nothing more than monitoring our buying and selling behavior. Because we're creatures of habits, the chart has a tendency to repeat itself. Understanding and educating yourself on how to read these charts places yourself in a high probability of knowing where the market is going to go. We make money by predicting where the market may go, not where it's been. That's what learning technical analysis is all about. A chart is a chart is a chart. Technical analysis is applicable to all markets, anywhere you can pull up a chart. Once you've been educated on how to read a chart, you will start to control your financial future in the market. Lesson 2 on support and resistance will be very helpful as we move forward. And lesson 7 here on the Fibonacci numbers, you need to understand what a high is. A high is 2 candles to the left and 2 candles to the right that are lower than either the body of the candle or the wick high. Here is that important information sign. Remember, not all highs are levels of resistance, only higher highs that are being created become new levels of resistance from where the market is. A low is the opposite. 2 candles to the left, 2 candles to the right that are higher than the wick low or the candle, the body of the candle low. You need 2 to the left, 2 to the right, once again that are higher, and not all lows are levels of support. Only lower lows that are being created become new levels of support from where the market is currently trading. Let's look at this chart. Please do not underestimate the financial game between the bulls and the bears. Bulls are trying to achieve new highs. Bears are trying to achieve new lows. Here we have the market, and these are your levels of resistance. As you find your levels of resistance, you start from the current market, which is the right of the chart, and you work your way to the left of the chart, finding higher highs. Those are all your levels of resistance. It's like stepping up a set of stairs. Finding support is like walking down a set of stairs. You will find lower lows. Please find all your levels of support and resistance before you trade. Now let's get started. In lesson 7, price swings and Fibonacci numbers. The best way to understand what you have learned is to write down what you think you know, then go back after you have been taught and look at what you thought you knew versus what you now know. Your perception is your reality. My perception is my reality. What we're trying to achieve via this lesson is to take our clear education of what a price swing is and Fibonacci trading is and have that become your perception. So write down in these following charts what you think you see and know about price swings, Fibonacci numbers, their retracement numbers, their extensions. Put this on pause as you go through this workbook. This is a Japanese yen 4-hour chart. Write down what you think you know about price swings, Fibonacci numbers, and extensions. Here's the next chart. This is the euro hourly. Put your machine on pause. I would like to point out that the Fibonacci numbers and swings work on all time periods. Write down what you think these lines are over here to the right. Put your machine on pause as you work through this exercise. Here's a Swiss franc 2-hour. Write down what you think you know, what you think is taking place in this chart. Try to find entries into the market. Where would be a good entry to get in the market, a safe entry, an entry of equity management? Here is a Japanese yen 4-hour chart. Write down what you think you know about Fibonacci's. Put your machine on pause. Here's the next chart. Put your machine on pause and write down what you think you know. All right, uptrend price swings. In order to understand the Fibonacci's, you need to understand the up and down trend price swings. An upswing starts at a low and ends at a high. The market moves in waves. These waves are called price swings. Uptrend price swings start at the low and stop at the high. Let's look at this price swing. See this low? It started here at this low and stopped at this high. That's an uptrend price swing. Uptrends are making higher highs and higher lows. Let's look at this chart. Look at how this high is higher than that high, and that high is higher than that high. Look at how this low is higher than that low, and this low is higher than that low. Uptrends make higher highs and higher lows. Look at this chart. Higher highs and higher lows are being created. Understanding the price swing and the extension. Now this is an uptrend price swing and its extension. It all begins with that original uptrend price swing. This is what's called an up price swing. It also has a second name called a rally. The market is rallying. Now let's look at this right here. Here the market rallied, but I'm going to start to dissect this move right here. This is called an uptrend price swing. Now you're going to learn during this lesson that there are swings inside of swings. But let's stay focused right here on this swing. This low, 2 to the left, 2 to the right, to that high, 2 to the left, 2 to the right. This is an uptrend price swing. Look at it. See that? The low to the high. Now, as the uptrend price swing rallies, it then retraces. It is now retracing the up price swing. As it starts to retrace the up price swing, that is called a reaction. It is also called the retracement of the upswing, and it is now making a down price swing. Look at this down price swing. This is the start, that's the stop. That's the high, that's the low. It begins there and ends there. This in itself is a down price swing. It is also the reaction. That's what it's doing. It's dipping. And it is the retracement of this upswing. Let's look at what the market's doing. Here it is. It's retracing the down, or excuse me, it's retracing the upswing. See how we had a rally? Now we're having a reaction. Now the uptrend price swing, after it has rallied and retraced, is now going to work on what is called a new rally, a new price swing, a new up price swing. It is now going to start to create potential sideways movement. It is also going to create potential extension, and it is now, as it is rallying, it is retracing this downswing. See how if we took this whole upswing out and only focused in on this downswing, this is then the retracement of this downswing. Now let's look at this chart. Or before we look at this chart, what I'd like to point out is the uptrend price swing and extension may move sideways before it becomes actual extension. Now we had a rally, a retracement, and now a new rally, but sometimes before it continues in its uptrend fashion, it moves sideways first. This is now called the retracement of the downswing, but it also is called sideways movement. Let's look at this chart. Here was the original rally. There's the retracement. This is sideways movement. It is movement inside the original swing. This is where traders have a tendency to get very confused in the market if they're looking at swings, because they have a tendency to say, oh, here is the new swing. No, don't ever lose sight of the original swing. This is the original swing. All this movement inside these two lines are considered potential extension as well as potential sideways movement. And many times the market moves sideways before it rallies and makes an extension or reverses. Now you can see we're in an uptrend and we're staying north of the uptrend line. Now uptrend price swings and extensions. Let's look at it again. Here then is the level of resistance that the market would need to take out and achieve a new high. Once the market passes this level of